Welcome to your high-end daily market explainer for Thursday, August 20th, 2026. Man, I am thrilled you're tuning in today because this tape was absolutely fascinating. We're going to cut right through the noise, get straight to the razor-sharp data you need to decode today's action, and more importantly, prep you for tomorrow's open. So let's just dive right into it. Right out of the gate, let's talk about the Nifty 50. It closed today at exactly 24,232. That's up 154 points, simultaneously locking in a solid 0.6% gain on the session. But hey, here's what you absolutely have to keep in mind: the new expiry schedule. We're tracking the Nifty weekly options expiry, which now lands on Tuesday, August 25th. That Tuesday settlement is a total structural shift, and you really need to have that hardwired into your trading calendar. And looking over at the Sensex, wow, we saw a closing level of 77,538. That is a massive 628-point surge, scoring a 0.8% gain right there. Now, this strength is particularly notable because it was firmly anchored to today's Thursday options expiry for the Sensex. Remember, under the whole one exchange, one day split, the Sensex runs its own weekly expiry right now on Thursdays. That means its levels and max pain metrics matter just as much as the Nifty's do. So here's the million-dollar question, right? What actually snapped that brutal 7-day slide we've all been sitting through? Because markets, they don't just reverse on a dime without a major catalyst. Well, the answer actually lies offshore. The U.S. Treasury finally stepped in to contain the surge in global bond yields. It acted like the ultimate pressure release valve. By intervening to cool off those global yields, they essentially lifted this huge heavyweight that had been dragging down domestic equities all week. This really perfectly illustrates the broader macro environment we're operating in right now. Both major central banks are basically taking a breather. The U.S. Fed is sitting on its hands at 350 to 375%. That's their fifth straight hold, by the way, while our own RBI remains planted at 5.25% with a completely neutral stance. So with no fresh rate shocks coming through the window, a softer dollar and those retreating U.S. 10-year yields became the ultimate catalysts. This combo is exactly what revived risk appetite across emerging markets today, literally the biggest macro tailwind behind the whole rebound. Let's pivot to the sector breakdown and see how this actually built into market breadth. Unsurprisingly, with risk-on sentiment fully back in the driver's seat, the tape was a sea of green. Media led the charge, up a very healthy 2.1%, followed closely by realty, which tacked on 1.4%. IT and private banks, also notably firm today. But, it wasn't a total free-for-all. If you look at the laggards, chemicals and PSU banks were the rare sectors that actually ends up closing in the red today. All right, moving on to Section 1, Top Market Movers and the Micro View. You really have to notice the stark contrast in fortunes here. On the risk-on side, both MCX and MUTHOOTFIN absolutely surged today, and they share one common catalyst: gold hitting a 2-month high on that softer dollar. MCX saw this massive jump in commodity market turnover and options volumes. Meanwhile, India's largest gold loan NBFC, Muthoot, rallied because, well, higher gold collateral values instantly improve those loan-to-value ratios and lower their default risks. Now, on the flip side of that, PSU power financiers PFC and REC dropped for a third straight session. Why? Morgan Stanley downgraded both to equal weight, slashing their targets due to this growing disconnect between loan growth and sector credit. Tough day for them. We also had a really interesting trio of notable gainers, all popping roughly 3.8% today. COFORGE hit an impressive 8-month high as the IT sector rebounded on those cooling yields. Remember, AI-led engineering and cloud now make up about 86% of their revenue. Premier Energies extended its incredible renewables capex momentum, catching a serious bid in this risk-on tape. And GLENMARK Pharma saw some fascinating rotational flows, capturing that defensive to cyclical buying. It's just a great reminder that money is always moving. You just gotta know where to look. Which brings us to Section 2, the scuttlebutt sweep. Time for some unverified rumors. Now, on a low rumor day like today, these unverified whispers are purely for your awareness. Treat them with a healthy dose of skepticism until the ink hits the paper, okay? First up, the rumor mill is churning out recurring reports that Bain Capital is eyeing a majority stake in Cello World. The exchange actually queried this, and the company issued a denial, so the risk here is very live. But hey, if it's true, the control premium re-rating would be absolutely massive. Second, we're seeing persistent, though totally unverified, large order chatter around Tata Tech on the forums following some recent volume spikes. And lastly, Murmurs are getting louder that Vedanta Aluminum is looking to raise a staggering 13,500 crores from major domestic banks post-demerger. Again, treat these as awareness only, but definitely keep them on your radar. Let's pivot to Section 3, tomorrow's playbook. Key levels you need to watch. Because look, knowing today's close is only useful if it prepares you for tomorrow's open, right? So here is the technical roadmap for the Nifty ahead of that Tuesday expiry we talked about earlier. Max pain currently sits right at 24,250. Looking higher, your immediate hurdle is the 20-day EMA, sitting right in that 24,290 to 24,320 zone. If the bulls can actually force a sustained move above that, we could easily see the index open up toward 24,450. But if things roll over, your key support is sitting between 24,130 and 24,100. A breach there, and we risk a drift all the way back down toward the 23,950 level. And that brilliantly illustrates the massive elephant in the room right now. Brent crude is just stubbornly holding above $90 a barrel. Unresolved tensions between the US and Iran are keeping a hefty war risk premium baked right into the barrel price. Frankly, this is a massive macroeconomic overhang. It constantly pressures the oil marketing companies, aviation, and paints. A sudden de-escalation here is easily the biggest two-way macro risk sitting on the board right now, for sure. So let's move to the timeline and see how the offshore catalysts are lining up, because this is what's actually going to move those macro needles. We have the Nifty expiry coming up on Tuesday, August 25th, but the heavy hitter you absolutely must track is the Jackson Hole Symposium from August 27th to the 29th. With central banks currently on hold, this symposium is going to be heavily scrutinized for the very next major policy signal. Oh, and finally, keep the MSCI rebalance changes in mind as they take effect right at the close of August. All right, tying the macro and the micro together, here is our specific idea in focus for tomorrow's session, ONGC, from the long side. This upstream PSU is a direct play on crude beta. As long as Brent holds above 90 on that unresolved US-Iran tension, the realization tailwind for ONGC persists. So the primary catalyst is that war risk premium staying elevated. But remember, and this is absolutely crucial, the explicit risk to this setup is a sudden US-Iran de-escalation, causing a sharp crude reversal. Manage your sizing accordingly on this one. So, I'm going to leave you with this final thought for the evening. Will the heavy overhang of $90 crude ultimately crush the momentum of tomorrow's rally, or can the bulls keep squeezing through the technical resistance? Think about it. And hey, hit that no scroll subscribe button and ring the bell, because in this market, hesitation costs way more than a click. As always, not investment advice, just razor-sharp research. I'll see you at the opening bell.